It's my great pleasure to be able to introduce Dan Tarullo, who, of course, is a governor of the Federal Reserve. He served since Barack Obama appointed him in January 2009. I've known Dan for a long time, but I never actually read that stuff they put on Wikipedia about you. Nothing embarrassing, don't worry. I'm sure it's been edited by the Fed Public Affairs staff and the ethics lawyers. Governor Tarullo is probably unique among Fed governors, at least in my experience, that he actually got a master's in English at Duke before he succumbed to law school, went to law school. And of course, those of us who've been in Washington for a long time know that he spent a great deal of time as an advisor to Ted Kennedy in the days when stuff actually got done in Congress. But since he played out that string, and then he worked in the Clinton administration, but turns out you can't get anything done in the White House either. So when he had the opportunity to basically write his own ticket, he chose, to the surprise of many of his peers, to go on the Federal Reserve Board, which is not where lawyers usually find themselves. But Dan has become really the chief overseer of the banking system at the Federal Reserve. He defined his ambitions in a New York Times piece I found that the regulatory and supervisory reforms we undertake will significantly reduce the incidence and severity of financial crises, which seems to me a pretty worthy goal. You missed this earlier. Gary Gorton has given us a new goal, is that don't do things that people 100 years from now will say, how could they have been so stupid? But another of Dan's accomplishments is there's a very small set of people who command the respect of both Elizabeth Warren and Larry Summers, and Dan is in that small set. Dan Tarullo.
Thank you, David. So the topic David assigned me to for this session, I guess, was shadow banking. And I know you've been moving around a bit from around various topics, asking the question of, are we safer now? But that is where I'm going to try to focus my remarks. The financial crisis highlighted two major vulnerabilities in our financial system. First, of course, was the magnitude of the too big to fail problem. And second was the size and fragility of what was called the shadow banking system, and the extent to which shadow banking activities not subject to prudential regulation were integrated with the regulated banking sector. In the intervening years, much has been done to address too big to fail. With regard to shadow banking concerns, the specific forms related to mortgage lending that linked the regulated and unregulated sectors, such as through the notorious SIVs, collapsed during the crisis. Changes in capital, accounting, and other regulatory standards make these arrangements very unlikely to reappear. Moreover, the kind of very large non-bank financial firms whose failure deepened the crisis are now subject to consolidated prudential regulation and supervision. So in a quite direct sense, the answer to the question posed by this conference of whether we are safer than before the crisis is easy to answer in the affirmative. Of course, safer does not necessarily mean safe enough. With respect to the largest banks, we continue to pursue the aim of promoting orderly resolution through evaluation of their resolution plans and through the long-term debt requirement that we proposed a few weeks ago. In addition, the banking agencies will be proposing a net stable funding ratio rule aimed at assuring adequate medium-term liquidity over the course of the next few months. And the Federal Reserve is currently engaged in a review of its annual stress testing and capital planning exercises, one goal of which is to reflect better the range of risks confronted by these institutions. With respect to shadow banking, the circumstances are somewhat different. While the specific pre-crisis linkages to the regulated sector have been removed or are now better regulated, the possibility of other connections remains. More generally, risks to financial stability may arise anew from activities mostly or completely outside the ambit of prudentially regulated firms. Shadow banking is not a single identifiable system, but a constantly changing and largely unrelated set of intermediation activities pursued by very different types of financial market actors. Indeed, the very rigor of post-crisis reforms to prudential regulation may create new opportunities for such activities. The aphoristic warning to avoid too much emphasis on fighting the last war since wholly new risks may have arisen, seems particularly applicable in this area. Yet there is simultaneously the opposite danger that the regulatory response to shadow banking will be too broad and too unidimensional. Indeed, the very term shadow banking tilts in that direction. This afternoon, I'll try to to identify some of the circumstances that could help us navigate between the perils of underappreciating the risks to financial stability arising from and the costs from overreacting to new forms of non-bank financial intermediation. Along the way, I'll be making a few points. One is that analytically, it's essential to disaggregate the various activities that fall under the loose term shadow banking and to assess the risks and benefits they present on a discrete basis. A second is that notwithstanding the manifold nature of non-bank intermediation, it still remains useful to identify the relationship of specific activities to the prudentially regulated sector. A third is that institutional considerations will be important in defining the potential and actual regulatory responses to non-bank intermediation. As you've probably inferred already, I have some misgivings about the continued use of the term shadow banking as a shorthand for various forms of non-bank financial intermediation that may need a regulatory response. The term conjures up a picture of lending and borrowing that resembles activity associated with, but not conducted by, commercial banks, which is in itself both over and under-inclusive of actual risks to financial stability. Before elaborating on this point, though, let me review how the phrase does capture, well, the activities that played such a large part in precipitating and exacerbating the financial crisis. Prior to 2007, large banks provided credit and liquidity support, whether explicit or implicit, for a range of intermediation activities, including finance companies, non-bank mortgage lenders, structured investment vehicles, and asset-backed commercial paper conduits. All of these entities engaged in maturity and liquidity transformation, frequently accompanied with significant leverage. Many created, through securitization or otherwise, assets that were viewed as cash equivalents, safe, short-term, and liquid. That is, at least in normal times, they were seen as comparable to demand deposits created by the traditional banking sector. Thus, what we might refer to as the prototypical form of shadow banking presented the kind of risk associated with traditional banking prior to the creation of deposit insurance, that of destabilizing short-term creditor runs that lead to defaults and asset fire sales. Bank sponsorship contributed to the illusion that the shadow bank short-term liabilities were virtually as good as cash. Large banks also relied on short-term wholesale funding provided by the shadow banking sector as a source of cheap financing. Then, questions arose about the quality of the mortgage loans and other assets underlying the liabilities of CIVs and asset-backed commercial paper conduits, and simultaneously about the continued willingness and capacity of their sponsors to support them. Suddenly, asset-backed commercial paper was no longer seen as a cash equivalent, and a run ensued. Large investment banks also experienced dramatic runs on their short-term secured wholesale funding. As noted earlier, some key elements of pre-crisis shadow banking, such as CIVs, have vanished, and some key actors of that earlier period have been brought within the bounds of prudential regulation. Today, the shadow banking sector is smaller, and the traditional banking sector is more resilient. Nonetheless, abundant global liquidity continues to seek out safe assets, and some financial market participants will continue to accept maturity and liquidity mismatches in order to earn incrementally higher yields. The risks associated with short-term wholesale funding in particular have more receded than disappeared. Accordingly, that prototype of the precarious shadow banking model can generate new variants that should command regulatory attention. Before returning to that specific issue, though, I want to speak more directly to why, and perhaps more importantly, how, we should analyze the risks and benefits associated with specific forms of non-bank financial intermediation. Switching from a focus on shadow banking to a consideration of the varieties of non-bank intermediation reinforces the importance of assessing specific risks rather than merely categorizing activities as either shadow banking or something else. In this way, the potential over-inclusiveness for financial stability purposes of the tag shadow banking can be better avoided. Even non-bank intermediaries that engage in lending to consumers or small businesses are not themselves monolithic, insofar as the sources of their funding, and thus attendant run risks, may differ markedly. On the other hand, financial stability risks are not limited to entities or activities that seem to replicate the kind of lending conventionally associated with commercial banks. This is where the potential under-inclusiveness of the shadow banking category arises. Here again, though, it's important not to leap to the conclusion that where some risks do exist, they should be addressed in a uniform manner. For example, to take a contemporary point of discussion, some classes of asset managers, such as bond funds that hold relatively illiquid assets, while offering their investors the right to withdraw funds on very short notice, may pose redemption risks. But intermediaries such as many conventional mutual funds do not pose bank-like risks, since they are generally, at least, not leveraged. So if further analysis supports the conclusion that redemption risks are real, the optimal regulatory response would surely not be one that treats all asset managers as quasi-banks that need to have capital and similar bank regulatory constraints. An emphasis on actual risks can also lead to the conclusion that some non-bank financial entities or activities do not pose material threats to financial stability at all. I'm going to mention pension funds now, and you may wonder why I'm mentioning pension funds, and the reason is that in at least some efforts by some observers to begin getting their arms around what they call shadow banking, pension funds have been mentioned. But while they're surely an important form of intermediation, and if over time they don't have assets sufficient to meet their promises to plan participants, hardship will undoubtedly follow, and that's whether because they've been underfunded in the traditional sense or because they've lost money through ill-considered investments. And if enough pension plans fall short of expectations, there may be macroeconomic consequences. And if they provide short-term funding in order to increase returns on the assets they need to keep liquid, they might contribute to the risks assumed by other kinds of intermediaries. But in themselves, they're unlikely to pose financial stability risks. And I think similar reasoning would apply to traditional insurance activities. Now, even as risks associated with specific forms of non-bank intermediation are evaluated, it's important also to bear in mind the specific economic benefits of those activities. Non-bank intermediaries can increase the diversity of the economy's capital providers. To take a historical example, the creation and eventual proliferation of equity mutual funds offered a variety of savings options to American households for which ownership of a diversified portfolio of equities is either practically burdensome or financially impossible. This development posed a challenge for the liability side of banks' balance sheets as households reduced the share of their savings in traditional bank deposits. But it's hard to argue that this challenge would have merited limiting, for example, the availability of mutual funds. Non-bank intermediaries can also provide credit to borrowers that are underserved or unserved by traditional banks. It could be argued that one example of such non-bank activity is online marketplace lending that uses new sources of data and new technologies to lower the fixed costs of making credit decisions, rendering lending to some individuals and small businesses more cost-effective. Of course, it matters a great deal whether this competition to traditional banks arises because risks are genuinely lower or useful new products have been created on the one hand, or because well-grounded prudential or consumer regulations have been successfully avoided on the other. A key implication of the fact that the activities often grouped under the heading shadow banking are not monolithic is that the level of a particular activity is less important than the degree of vulnerability that it creates. Not all of what some would call shadow banking activity represents a market failure that creates excessive risk. And so it would be wrong to assume that all shadow banking ought to be regulated to safeguard financial stability. This view is now incorporated into the Global Shadow Banking Monitoring Report, which is done annually by the Financial Stability Board. The 2015 report, which has just been issued, begins by including all activities that could arguably fall within the category of shadow banking, but then proceeds to classify these activities by economic function and then by risk. The result, or the conclusion, is about a 70% decrease in the amount of intermediation that would otherwise be captured by the broader definition. So in assessing whether regulation is appropriate for specific forms of non-bank intermediation requires the balancing of the resulting increase in socially beneficial credit, capital, or savings options against any associated increase in risks to the safety and stability of the financial system. And here I think in doing this balancing, the chief relevant factors to consider would be the extent of reliance on maturity or liquidity transformation, the creation or not of cash equivalent assets, the use of leverage, and the degree of interconnection with the traditional banking sector. When growth in non-bank intermediation reflects a migration of traditional banking activities to less regulated entities, a number of similar considerations are relevant to an evaluation of the costs and benefits of the migration and the potential need for a regulatory response. Here, where the activity is probably quite bank-like, I'm going to revert to the use of the term shadow bank. First, to what extent does the activity as practiced by shadow banks entail reliance on leverage or on maturity or liquidity transformation that could lead to a bank-like creditor-run dynamic? Bank regulation is primarily aimed at preventing the occurrence of such destabilizing runs or minimizing their ill effects. And so the need for bank-like regulation is greater in the presence of material run risk. Second, are banks still informally or indirectly at risk despite the migration to non-bank entities? This could be the case if banks sponsor the shadow banks and implicitly or explicitly provide them with a liquidity backstop or credit support. And it would call for greater regulatory attention either to the shadow banks conducting the activity or to the bank's connection with those shadow banks. Third, is the activity at issue primarily migrating out of the most systemic banks, the global systemically important banking organizations, or GSIBs, or out of smaller banks? Migration of activity out of GSIBs might on net be beneficial for financial stability because it would leave the GSIBs less systemic, even if the activity migrates to less regulated shadow banks. Though here I would caution that an especially careful analysis would be needed before reaching this conclusion. In this regard, I'd note that one way to limit the growth of shadow banking that simply arbitrages bank regulation is to make sure that the regulated sector itself is not unnecessarily burdened. This aim lies behind our efforts at the Fed to tailor banking regulation by reference to the risks posed to the economy and the financial system by banks of varying sizes, scopes, and business activities. In addition, it suggests a couple of considerations for evaluating specific forms of shadow banking. Here, though, the relevance of these considerations is for determining whether to adjust banking regulation as much as it is for determining whether regulation of shadow banks would be warranted. One such consideration is whether the activity is high risk and whether banks have a good track record in addressing the attendant risks. Migration may be of less concern where banks historically have done a poor job of managing the risks of the activity in question. Another salient consideration is whether the activity at issue has significant synergies with core banking activities. If so, then regulation which incentivizes migration out of the traditional banking sector could damage the efficiency of banks and increase their vulnerability. Now, while I've spent quite a bit of time giving my sense that the specific risks and costs associated with a particular form of non-bank intermediation need to be assessed on a particularized basis, I should say that I also believe that the greatest risks to financial stability are the funding runs and asset fire sales associated with reliance on short-term wholesale funding. If there's one lesson to be drawn from the financial crisis, It is that the rapid withdrawal of funding by short-term credit providers can lead to systemic problems as consequential as those associated with classic runs on traditional banks. The total amount of short-term wholesale funding within the financial system is lower today than immediately before the crisis, though volumes are still large relative to the size of the financial system. Nearly half of the liabilities of broker-dealers, for example, consist of short-term wholesale funding, a level that is nearly the same as it was during the crisis. Now, numerous regulatory reforms have addressed the use of short-term wholesale funding by prudentially regulated institutions. The board has finalized the liquidity coverage ratio, is developing the net stable funding ratio, as I mentioned earlier, to diminish large banks' vulnerability to abrupt changes in short-term wholesale markets. Our annual comprehensive liquidity analysis and review provides an opportunity for supervisors to assess and, where necessary, to contain risks, require changes to the specific funding practices of large banking organizations. Finally, in order to increase the resilience of firms that continue to use significant amounts of such funding, we've incorporated a measure of a firm's reliance on short-term wholesale funding into the calibration of both the capital surcharge for the GSIBs and our proposed long-term debt requirement for those firms. But these measures, applicable as they are only to prudentially regulated banking organizations, do nothing to address the risks of short-term wholesale funding by non-bank intermediaries. Indeed, these constraints imposed on banking organizations may prompt more short-term wholesale funding to migrate outside the regulated sector. In the past, bank backstops were generally needed for shadow banks to obtain substantial amounts of such funding. But I think it not so far-fetched to believe that with time and sufficient economic incentive, the financial, technological, and regulatory barriers to the disintermediation of prudentially regulated banking firms could be overcome. Indeed, we've observed some investment funds exploring the possibility of disintermediating dealers by lending cash against securities collateral to other market participants. While it would be inadvisable to apply bank-style regulation to all entities that make use of short-term wholesale funding, a degree of consistent regulatory treatment is desirable to address bank-like risks in the shadow banking sector and to forestall regulatory arbitrage. The board has advocated international measures to forestall the development of highly volatile funding structures outside the regulatory sector. And consistent with this position, we'll be developing a regulation that would establish minimum haircuts for securities financing transactions on a market-wide basis rather than just for specific classes of market participants. These securities financing transactions, or SFTs, include repo, reverse repo, securities lending, and securities margin lending, transactions that are the lifeblood of many kinds of shadow banks. Now, SFTs are a key component of the healthy function in the securities market, but in the absence of sensible regulation, they also carry the potential for prompting the fire sale dynamic described earlier. While the haircuts and other conditions associated with securities financing transactions today are considerably more conservative than during the period leading up to the crisis, there's good reason to believe that this conservatism could be eroded as economic conditions continue to improve and credit growth accelerates. A system of numerical haircut floors for SFTs would require any entity that wants to borrow against a security to post a minimum amount of excess margin to its lender, with the amount varying depending on the asset class of the collateral. Like the minimum margin requirements that U.S. regulators have imposed on derivatives contracts, numerical floors for SFT haircuts would serve as a mechanism for limiting the buildup of leverage in the financial system and for mitigating the risk to financial stability posed by pro-cyclical margin calls during times of financial stress. Now I'm going to shift my last few remarks to what I've termed institutional considerations. Because while the analytics of shadow banking or non-bank intermediation more generally lean towards a case-by-case balancing of risks and economic benefits, the actual way in which these activities can be regulated depends, of course, on the structure of institutional realities. There are a lot of issues that probably are worth consideration, but in the interest of time today, I'm only going to mention two. First is the issue of what form of regulation is appropriate once analysis suggests that a response is needed. By authorizing the FSOC to designate non-banks as systemically important institutions, Dodd-Frank fills the gap that existed in the pre-crisis period when firms like Bear Stearns, Lehman, and AIG largely escaped the perimeter of prudential regulation. Designation by FSOC places firms under the regulation and supervision of the Federal Reserve Board. Important as the designation authority is to preclude the Lehmans or AIGs of the future, though, it is almost surely not the optimal regulatory approach for most activities that can be characterized as shadow banking, or that are conducted by non-bank intermediaries so as to raise financial stability concerns. The vast majority of firms engaged in such activities will not satisfy the statutory test for designation, and in any case, it's not so clear that at least some of the statutory prudential requirements for designated firms would be necessary or appropriate in dealing with the risks to financial stability posed by the activities of such firms. In many instances, and I think especially where funding vulnerabilities are at the heart of a business model, it is the activity itself that needs to be regulated in some way, whether there are a few large firms or many smaller ones involved. A tool that might be better targeted to actual risks while avoiding unnecessary bank-like regulation would be what I've previously termed prudential market regulation. That is, a policy framework that builds on the traditional investor protection and market functioning aims of market regulation by incorporating a system-wide financial stability perspective. This approach would take into account such considerations as system-wide demands on liquidity during stress periods and correlated risks that could exacerbate liquidity, redemption, or fire sale pressures. The specific policies associated with prudential market regulation might be transaction-specific or apply to certain kinds of business models. One example of such a measure is the SFT minimum haircut that I mentioned earlier. Generally, though, prudential market regulation would be a tool more available to market regulators, since it would apply to activities on a market or transactional basis. In an important speech that she gave last year, Securities and Exchange Commission Chair Mary Jo White provided a roadmap for just such a regulatory approach for the asset management industry. And as many of you probably know, the SEC has since begun to develop that approach. The second institutional issue that I'd flag this afternoon is the question of which regulators make the assessment and policy trade-offs that I'd contemplate in addressing financial stability risks associated with non-bank financial intermediation. Now, the natural answer would be the regulator with authority to act. And this may well be the best answer from a policy perspective as well, but it does raise some potential issues. For example, if regulators with responsibility for one sector believe that the failure of regulators with responsibility for another sector to act on financial stability concerns is creating debilitating disadvantages for firms in that first sector, they might be tempted to relax regulation on their firms, even though they might agree that the best outcome would be to retain their regulation while having the other sectors subject to some constraints as well. And in fact, I don't think this is a purely abstract or hypothetical possibility, because it seems to me a pretty good description of what happened in banking for a good part of the 3 decades beginning in the mid-1970s, when the banking agencies pursued a variety of deregulatory measures, at least in part because they believed that the franchise value of commercial banking was being eroded by various capital market activities that were not subject to appropriate prudential requirements. I'm going to conclude now by saying that the Financial Stability Board study to which I referred earlier notes, among many other things, that the growth of shadow banking in the United States in recent years has been relatively modest. With the regulated financial sector so much more resilient than in pre-crisis days, the financial system as a whole is obviously safer. Moreover, much of the innovation occurring in lending and payments arenas today carries the promise of genuinely increased efficiency and does not appear to be just an arbitrage against the stronger post-crisis regulatory regime. But if history is any guide, the grace period we are now experiencing will not last forever. New forms of intermediation may carry new risks, or older forms may acquire new risks as they expand and adapt to new circumstances. If we are to pursue what I think is the analytically attractive policy of case-by-case assessments that permit healthy forms of non-bank intermediation while protecting the financial system, then financial regulators will need to develop effective and supple mechanisms for what I've termed prudential market regulation. Thank you very much.
Thank you very much for that, Governor Tarullo. I'm going to ask a couple of questions and then let the audience have a crack at you.
A little too close.
That's too close. I'm not a reporter anymore. You have to worry about being so close. So I think that a caricature of the argument one hears is, okay, we had a crisis. They created a lot of regulation on the banks. That led a lot of activities to migrate to the shadow banking system. So now they're going to try and regulate the hell out of the shadow banking system. And this is an ever-ending recipe for more and more regulation, always trying to layer on, and it will either be collapse of its own weight or it'll have unwelcome effects on the supply of credit in the economy. So what do you say to those people? I know that's not your view, but what do you say to them?
Well, I think there could be a risk of that. And one of the reasons why I want to get away from the use of the term shadow banking is it tends, anybody can parse a term carefully, but in observing some of the early discussions of shadow banking among various official sector people, you did see that tendency to sort of say, we got to get everything that involves intermediation, or we have to get our arms around everything that involves intermediation with maturity transformation. And what I tried to do, David, in those prepared remarks was to, in an admittedly conceptual rather than applied way, try to identify some of the factors that we should be looking to in a fairly rigorous fashion in deciding which activities actually do pose risks. I think one of the reasons for the grace period, what I referred to as the grace period, is because so much of the pre-crisis shadow banking or non-bank financial intermediation was actually connected to the banks generally, and particularly the largest banks. That because a stop has more or less been put to that through the bank's own changes in orientation and through regulation, there's probably a period during which there's not a shadow banking or non-bank intermediation opportunity to fill in immediately. But that's what I think could change over time. And I think we just need to be aware of that on the one hand, while on the other hand saying not everything that intermediates is a problem. Not everything that intermediates with maturity transformation is a problem. One, I think, really needs to ask the question, to develop that kind of analytic framework and ask a question, somebody, back to the institutional issue, needs to ask the question, are there real risks being posed here? Because there's always, those who are competitors will always see risks. Those who have a particular mandate may be a little inclined to see a risk because it pushes them forward, and that's why I think these institutional questions are important, to get enough information, enough analysis, but critical thinking.
Let me ask you about that institutional thing. So if we're going to have a system where we're going to do sophisticated activity by activity assessment, it seems to me that the current, too much liquidity there? It seems to me that the current setup is particularly ill-suited for that, with a variety of agencies, different mandates, an FSOC that isn't clear that it has authority. Some people have financial stability mandates, some don't. It doesn't seem like that's well-suited for the world in which you're.
So I think it's early. It really is early days on that. And if you look at the FSOC reports over the last few years, I think you will find actually a quite thoughtful assessment of some things that might be thought of as potential financial stability risks. I would say, this is a little bit of Fed patting on the back, but I think within the Fed, we do have now a pretty sophisticated effort to think through potential financial stability risk. And I think it's not just sophisticated, but I think it's pretty, there's a lot of self-critical activity as well, led by Nelly's division, the Office of Financial Stability, but really including other divisions as well. And I would say that my own experience has been that in discussions with my counterparts in other agencies, we de facto are doing that kind of assessment. So I guess I would say that in the absence of a list of clearly problematic areas that clearly require action, and we're sitting there saying, why isn't anybody acting? That I think that we're getting time to develop the kinds of interactions that would allow this sort of assessment when the time comes to make it. But having said, as many people observe, there are advantages and disadvantages to a relatively decentralized regulatory system. You avoid having any one agency with dominating authority over all areas, but it does mean that by diffusing authority, you need to get sometimes more people on board before you can act.
Let me ask you one more question. So we are in a very unusual time when, because the Fed has been holding rates so low, the usual safe assets pay very little return. We heard discussion earlier of Treasury auctions at 0 rate. So is it possible that people who reach for yield are not so much taking credit risk, but are taking liquidity risk in the, I don't have a better word for shadow banking, in some aspects of the shadow banking? And how do you think of that? And particularly, how does that interplay when you think about using forward guidance in monetary policy? Like, are you creating your own problem there?
With forward guidance, creating a problem, how?
By encouraging people to take more and more liquidity risk to get yield, because they know they're never going to get a decent yield on the short term.
Look, I don't think there's any question but that in a sustained period of low interest rates, that there's going to be reach for yield. I mean, it's just a fact of life. And there's a reason why accommodation as a policy is kept in place, but there are obviously some downsides to that, and one of them is the reach for yield. I think that the issue of the forward guidance, I guess I can see, and I see what you're saying about that. I think it's one of the many reasons why I at least was more comfortable shifting away from calendar-based or explicit forward guidance towards something that, I'm not going to use the term data dependent, I'm going to say outlook dependent or outlook driven. But again, in specific circumstances where you're at the 0 lower bound, there may be a very good reason to use forward guidance as one of your available tools, and you just have to recognize that, again, there will be downsides. I mean, every policy action that anybody ever takes has merits, and it has some downsides associated with it. So the fact that a monetary policy action or a regulatory action creates a downside or a shortcoming is not a reason for saying that's a bad policy action. And indeed, I would say that some of the forward guidance pursued by the Fed and some other central banks in the sort of nadir of the crisis and the recession was a well-considered tool to be used under those circumstances. Whether one wants to use it in more normal circumstances is an entirely different question.
Okay, let's take a few questions. I think maybe to be efficient, I'm going to ask for a couple, and then we'll let Governor Tarullo respond. A gentleman there with a beard in the middle, followed by the gentleman with the beard in the back.
You can see the selection criteria.
Yeah, definitely.
The beard's left over from Halloween, so.
Tell us who you are.
My name's Nathan Copeland, New Rules for Global Finance, based here in D.C. I kind of want to come back to the point that Governor Tarullo raised about the migration of activity or entities out of GSIBs and whether that's actually beneficial. And that comes back to the question about, do we understand who's in the shadow banking system? I also agree with not a great term, but because we don't know, that's why the shadow word came up. So do you think, how do we approach that? And also, could you speak on one of the main initiatives coming from the Financial Stability Board, the legal entity identifier? And will that be a prerequisite for kind of addressing that issue or not?
Let me just take,
I'm
take
sorry,
another one.
sorry.
Take the one in the back.
I gotta use my memory here.
No, I took notes, so I'll make up the question.
Hi, is this on?
It's on.
John Heltman, American banker. I had a question about, it's not really related to shadow banking per se, but
We might not get an answer then, but okay.
but regulatory reform more generally. In Dodd-Frank, one of the sort of initiatives was the creation of a vice chairman for regulatory affairs. Seemed to be a cornerstone of the reform, and yet the position remains unfilled. Governor Tarullo, you've been effectively acting in that capacity. Just curious why that position remains unfilled. Do you want it? Do you not want it?
So let me get Nathan's question first. So I'm glad you asked that because I should have been, I was thinking as I read the speech that I should have been more clear that what I was doing in laying out those factors, that series of questions, was not sort of sub rosa alluding to current issues or current problems or current non-bank intermediation activities that fit each of those questions. It really was an effort to distill from pre-crisis experience, going back some ways, a set of questions or criteria which one could ask as a particular form of activity came before us. And you'll note that I qualified that one on the GSIBs by saying I thought we needed to be particularly careful or cautious in doing that analysis. The reason I thought we need to be particularly careful about it is, it's got this premise, well, if you reduce the systemic footprint of a GSIB, that's kind of presumptively a good thing. And, in isolation, that probably is kind of presumptively a good thing. But the fact that it migrates to the unregulated sector may carry with it costs that exceed those that would be associated with it continuing to be conducted within even the largest banks in the regulated sector, precisely because their regulators are watching what happens.
What
So
kind
it
of
would need to
activity
be-
are you talking about there?
That's why I wanted to be.
You don't want to say?
I don't want,
Okay.
because I don't want to suggest that there is something in particular.
Okay. Legal entity?
On legal entity, legal entity is, I think legal entity really is an important.
Define what it is for people.
Oh, the legal entity identifier is just an effort basically to get a standardized system throughout the world of identifying counterparties in financial transactions. And that, among many other things, will allow the aggregation of data with more of a sense of who's exposed to whom, either within financial institutions or across financial systems. It could well help with shadow banking insofar as you ask yourself the question, what are there intermediaries who are actually getting a lot of their funding from the regulated sector? And thus, in a sense, the regulated sector is taking on some of the risks of the unregulated sector. But it actually, it has intents and uses far more general than that.
And you want to take why haven't you appointed yourself the vice chairman yet?
I gotta ask the administration, can't ask me.
All right, let's take a couple more, if we have them. Woman standing in the blue?
Without a beard.
That'll be it, yeah.
Without a beard, I said, not with them.
Oh, without a beard, sorry.
Rena Miller with the Congressional Research Service. I'm just curious, to what degree are you concerned about overseas activities through affiliates kind of escaping the mesh of various regulations, whether it's market-based on derivatives or whether it's entity-based, and impractical as well as sort of legal terms?
Right, okay, so good question, and I think we need to distinguish between the regulated firms that are regulated and regulations that are applicable to activities. So with respect to firms, I'd say two things. One, the reason we have consolidated regulation and supervision is precisely because of what has been learned about the potential for problems arising in the overseas activities of a firm. And this is BCCI. That's sort of the poster child for that. When you have consolidated regulation, you, for example, with respect to capital, you have a consolidated balance sheet that looks at all the assets and that constructs leverage ratios and risk-weighted capital ratios, and in our case does stress testing against that entire balance sheet. Now, I don't think anybody would believe that we at the Fed and the OCC and the FDIC have as granular a window onto what's going on in other markets that is nearly as detailed as the one we have in our own markets. But that's where, among other things, supervisory cooperation comes in. So for us, for example, the Bank of England is an incredibly important interlocutor because all of our large broker-dealers and our large commercial banks have substantial London operations. So we require, on a consolidated basis, that capital be developed, and you see the counterparty risks across the whole firm on the one hand, and on the other hand, we have the advantage both of the fact that those firms have to be separately chartered in the UK and meet capital and liquidity requirements there, but also that we hear from the PRA, which is part of the Bank of England, as indeed they hear from us on their banks here. Now, with respect to activities, is obviously a different potential issue. And there, I think, you sort of have to make a judgment as to whether, if the activity is abroad, theoretically it's not affecting your financial markets. So if you're not capturing it as part of your firm oversight, and that because you're not particularly worried about the actor, just the act, then you might say, well, it doesn't matter if we don't have a window onto it. If you're worried about the actor, presumably you should be regulating the firm. If you're worried about arbitrage or unfair competition, then you really need to be moving towards some sort of international framework that creates at least workably convergent regulation, which, for example, is what we've done with over-the-counter derivatives, looking for common margining practices there. It's part of what animated the initiative on securities financing transactions. Why did we want to extend that framework to SFTs between non-bank actors, which today account for a very small proportion of activity? Well, the reason is because it would be so easily arbitrageable. It could move very quickly, so you want to have a convergent set of regulations in place. So the policy decision there basically is, if it's outside of your market and it's not by a regulated firm, presumptively, you might think, well, this is not really of concern to us, it's someone else's financial stability, unless you're worried that this is just part of a big arbitrage action, and if things are easily arbitrageable, it pushes you towards some sort of international framework.
Can I ask you one final question? You had this nice phrase in your speech about, we're undoubtedly safer, but are we safe enough? Mm-hmm. When you look across all the things we've done, how do you answer that question?
I mean, the concept of safety and financial stability, I think, necessarily needs to be dynamic, David. And so, as we sit here today, and as Nellie does her quarterly briefings of the board, it feels obviously and substantially safer than a decade ago. But the very nature of financial markets is one of a lot of adaptation, one of a fair amount of arbitrage, fair amount of innovation. And so the reason I asked that question about safer is, and why my conclusion said we got to push towards what I call those more supple analytic and institutional mechanisms, is precisely because the moment where you tell yourself, hey, we're safe enough, is when the problems are going to start to arise. And you don't even have to go down a Minsky-like road. You might want to, but you don't have to go down that road in order to think that is where you're going to start.
Okay, so we can never answer the question, yes, we're safe enough. Because that would be self-defeating.
Yeah, I think that doesn't mean you always need more regulation at a particular moment in time, but I think the analytic and regulatory processes always need to be aware of what's changing in markets.
Okay. Well, please join me in thanking Governor Tarullo for his time. And to comply with Fed ethics regulations, you have to move that way so Bernanke can come up this way. And can I ask Daryl and Anil and Gary to come up and join me for our final conversation? Thank you very much, Dan.
Sure.